Canada posted its first trade surplus in 6 months on the same day its oil executives warned the country is losing its competitive edge. That contradiction is the story. The surplus, $1.78 billion in March, against expectations of a $2.88 billion deficit, was driven almost entirely by a 15.6% surge in energy exports, the highest since late 2022. The cause was not Canadian policy, it was a war in Iran. The U.S. naval blockade has now removed roughly 20 million barrels per day of Gulf crude from global markets. Iran's own production has been cut by an estimated 400,000 barrels per day as storage fills and exports stall. The U.S. Energy Secretary confirmed this publicly on Thursday. Western Canada Select, which began the year at roughly $50 per barrel, has climbed above $85. Brent crude hit $100 per barrel, a 40% move since February 28, when the bombing campaign began. For Canadian Natural Resources and Cenovus, the revenue impact is immediate. Canadian Natural averaged 1.64 million barrels of oil equivalent per day in Q1 and beat analyst forecasts. Cenovus reported net earnings of 1.57 billion Canadian in Q1, nearly double the prior year, and hit record upstream production above 972,000 barrels per day. Both stocks have gained meaningfully since the conflict escalated. The supply shock, however, is now outrunning the market's ability to absorb it. The IEA has called this the largest oil supply disruption in history. Global petroleum inventories are depleting at a pace that analysts say has no recent precedent. Even a near-term reopening of the strait would not immediately refill those inventories. The physical disruption, in other words, is ahead of what futures markets are pricing. The countersignal here is the UAE. Emirati tankers are now running through the Hormuz with transponders switched off, a technique previously associated with sanctioned Iranian ghost fleets, to extract crude bottled up inside the Gulf. That tells the market two things. Some oil is moving, but only through improvisation, and the cost of that improvisation is being priced into the global system. The question Canadian oil executives are now asking is not whether prices stay elevated, it is whether Canada can move enough crude to capture the demand surge before the war ends. That question brings a structural constraint into focus that has defined the Canadian oil sector for over a decade. The surge in oil prices is real. The ability to route additional barrels to the Pacific, where Asian refiners starved of Middle Eastern crude are paying premiums, is limited. Trans Mountain, Canada's only West Coast pipeline, may have up to 10% of unused capacity. Rail can absorb some incremental volume, but President Scott Stouth of Canadian Natural said plainly this week, a new 1 million barrel per day pipeline from Alberta to the British Columbia northwest coast is necessary for any significant growth phase in oil sands output. That pipeline does not exist. Approvals, financing, and construction would take years. Meanwhile, Cenovus CEO John McKenzie used his earnings call to warn that Canada's regulatory framework and industrial carbon tax, set at 130 Canadian dollars per metric ton under negotiations still ongoing between Alberta and Ottawa, are actively driving capital to competing jurisdictions. Only one new greenfield oil sands project has been approved and built in Canada since 2013. The tension here is timing. The Iran war has created the clearest case in a generation for Canadian oil exports. The infrastructure to act on that case will not be ready in time. What Canadian producers can do is demonstrate output discipline, capture WTI plus pricing where pipeline access allows, and push the policy argument while commodity momentum is on their side. Western Canada Select settled at $15.80 below WTI on Thursday, a differential that is narrower than it was at the start of the Iran conflict, but still wide relative to the pricing Canadian producers would earn with full Pacific access. That spread is the cost of the missing pipeline, expressed in dollars per barrel every day. The intersection with the broader trade picture sharpens the case further. Canada's finance minister is running a digital trade mission this week. Ottawa is preparing for what it calls a robust CUSMA review with both the U.S. and Mexico. A major Mexican trade delegation, 240 companies, more than 1,800 business-to-business meetings in Toronto and Montreal, arrived Thursday precisely because both countries recognize that Washington's approach to the trilateral agreement is unpredictable. The common thread is that Canada's commodity exports, and particularly oil, are now the strongest card in any trade negotiation. A court ruling out of the U.S. Court of International Trade added a further dimension Thursday. The court ruled 2-1 against Trump's 10% global tariffs under the 1974 Trade Act, finding the balance of payments rationale insufficient. The ruling is narrow. It covers 2 small businesses and the state of Washington only, but it signals legal fragility in the tariff architecture that has cost U.S. automakers $12.5 billion on Canadian and Mexican vehicles alone since April 2025. The oil story and the trade story share a mechanism. Energy security is now the most durable argument any Canadian industry can make. Honda confirmed Thursday that it is indefinitely shelving its planned $15 billion electric vehicle and battery complex in Ontario. That plant was supposed to anchor Canada's EV supply chain ambitions. Its cancellation is a direct consequence of the same cost and demand pressures, compounded by tariff uncertainty, that have reshaped the North American auto sector. On the same day, Ontario directed its grid operator to enter a cost-sharing agreement with Bruce Power, advancing the first major nuclear project in the province in 3 decades. The timing is not coincidental. The Bruce C expansion will create an estimated 18,900 jobs and supply baseload power to a grid that no longer has the Honda demand anchor it expected. NexGen Energy's Rook-I uranium mine in Saskatchewan is now in its final regulatory phase. Part 2 of the Canadian Nuclear Safety Commission hearing concluded Thursday. If approved, Rook-I would produce up to 14 million kilograms of uranium annually, enough to make Canada the world's largest uranium exporter. The project is estimated to generate $38 billion in revenue over 24 years. The CNSC decision is imminent. The causal link from Honda's exit to nuclear investment is not speculative. Ontario needs power generation that can absorb industrial load at scale, is immune to EV demand cycles, and is eligible for clean energy credits under both domestic and potential U.S. frameworks. Nuclear satisfies all 3 criteria in a way that was less visible when Honda's battery plant was on the drawing board. The forward conditions are now straightforward to state. If the Iran conflict extends through the summer, Canadian oil producers will continue to benefit from elevated prices but will be constrained by pipeline capacity. The WCS differential relative to WTI is the number to watch. A narrowing below $12 suggests the pipeline constraint is being absorbed by demand. A widening above $18 suggests the physical market is losing confidence in Canadian supply growth. For the nuclear trade, the CNSC's Rook-I position is the single near-term trigger. Approval would be a direct catalyst for NexGen and would validate the provincial direction toward Bruce C. A delay past June would push the investment case into 2027. The scenario that flips both of these trades is a rapid ceasefire in Iran and a Hormuz reopening. That would compress oil prices, remove the premium that is currently subsidizing Canadian producers, and slow the urgency of the energy security argument that is driving nuclear investment. Markets are currently pricing a negotiated deal. Gold pulled back from its 2-week high Thursday on Iran deal optimism, and TSX inched higher on the same sentiment. If that optimism resolves into a genuine ceasefire, Canadian energy equities face a repricing that the pipeline constraint alone cannot offset. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.